Recording in progress.
Microphone already on there.
So how was everyone? How was lunch? Is lunch good? Do you guys prefer pizza or Subway? Do you want to be unhealthy or do you want to be healthy? I'm gonna do this again, okay? Because you guys are a little bit slow, okay? Do you guys like pizza or do you guys like Subway? Do you want to be unhealthy or do you want to be healthy? Well, I picked healthy, and of course, none other than Donna. Oh, did I say Donna? Happy birthday to you. Happy birthday to you. Happy birthday to Donna. Happy birthday to you. Now, I'm not going to say this because you guys are all smart. Guess whose birthday it is? It was Donna's birthday yesterday. She is very, very dear to us, right? She's always been so supportive. And of course, Graham, right? We love them both. We want to thank them for providing us a wonderful lunch. And really, we say a lot of things, but their actions speak louder than the words, right? So I want to introduce you again to Graham and Donna. Tell us what you got for us today.
Sir.
Who else sings happy birthday to you like this?
The other one that Donna said? I think it's the last one that she signed.
I still not receiving the email yet.
Hey guys, I'll just start talking as they load up the slides. So today we brought a fabulous partner with us, Rizwan Qureshi from Equitable Bank. Later on, after I bore you guys a little bit, he's going to get into reverse mortgages, which is a phenomenal product, and there's a lot of placement for it. So he's going to let us know how that's going to help our businesses. And he's also going to talk a little bit about the alternative side, which is the B lenders, which is also a great opportunity to do a lot of things on appraised value. I'm not going to steal his thunder. He's going to talk about a lot of great products. So we're going to want to sit tight and wait for him to get into that. I'll just do a quick market update, just let guys know what's going on. We're still seeing a huge uptake on the 3-year fixes, around 4%, but the variables are becoming a more and more attractive product as the Bank of Canada continues to slash interest rates. Yes, inflation numbers just came out and they show a little bit higher than anticipated. However, Tiff Macklin, they're still saying that the 50 bips drop in December 11th is still not off the table. Okay, so we're weighing in on quarter 50. You'll hear some rumors about will they pause? I don't believe so. We'll see, but we could still be in trending in the right direction with these decreases. Okay, so these interest rate slashes should continue, and we should see another 1% over the next 9 months. So whether we do it quarter point or half point or half pause, whatever it is, we're still going to be in a much better position in the next 9 months, and especially kicking you guys off into the spring market. The interest rates are going to be very attractive. Okay. As far as the alternative side, which Riz will get into, I think their rates, what do you got going on now, Riz? What can I get?
You could get 5.59 on a 1 year.
Okay, unbelievable. So 5.59 on a 1 year. 3 on a 3?
5.3.
5.34 on a 3. So just to let you guys know, these are for clients that we can get them a little bit more mortgage. For people even like yourselves that are business for self, and we're using stated income where you keep a lot of money in your corp, you don't pay yourself that much. So on the CRA, it doesn't look like a lot of income's earned. We can use bank statements, things of that nature to increase your mortgage and actually base it on your gross with minimal expenses. So the fact that you can get into a product as low as 5.34, I mean, we were writing A deals a year ago at the sixes. Okay. It's a very attractive for clients and, for our investor clients that are writing off the interest anyway. It's a great way for them to secure an additional property potentially earlier than they could on the A side. So we have a lot of potential to help those clients out. And I know some of you guys do pre-construction. We've got an event coming up this weekend with Sharon. Yay. And we also they have a phenomenal, unique product that actually allows you to get a mortgage based on an appraised value. Okay. He might talk a little bit about that a little later on. So just a little bit about the changes that are going on. And I know we've talked about it before. We've sort of hinted on it. Kelly, you have a clicker. Oh, sorry. So we just want to bring it back to your attention because this is the number one question that we're being asked. And it's something that a lot of our clients are waiting for. So we have clients that are sort of sidelined themselves as this change is coming up within a month. So people have sort of sidelined a little bit to wait for this additional qualification that they could potentially get a higher mortgage. So the big changes that we know is one, the cap has increased on insured mortgage to 1.5 million. And I know when they first came out with this and we were in a room and people were saying, well, yeah, 1.5 million minimal down payment. It's so hard to qualify. Who does that? We have a lot of people on our personal books that are in this category. So the people that you'd be looking at that this is really going to help is your young professional clients, right? So maybe it's a married couple. They both have a good income, but they've only been, in the workforce for 2, 3, 4, 5 years. They haven't had time to save up $350,000 in down payment, but they can manage the monthly payment. The fact that they could potentially get, on a $1.5 million mortgage, their down payments under 100 grand, 75, like that is key in order to get them into the market a lot sooner. So a lot of our clients are sort of waiting for this increase in order to get the property they really want, instead of taking that stepping stone where, they take a condo because they don't have the down payment, build up equity, and then they get into the property that they can afford today, but unfortunately they don't have the down payment and they didn't have an option to do that because the properties they're looking for, especially here in Toronto, are north of $1 million. So we have a really great opportunity to go through our books, go through our databases, and get to these clients that could potentially make moves a lot sooner than they could just today, right? So this is going to take effect December 15th, and that's a huge opportunity for them. The 30-year AM is going to help all our new first-time home buyers on both pre-construction and resale properties. So as long as you're a first-time home buyer, you're going to be able to get that 30-year AM. That's going to help again with the qualification and for budgeting. First-time home buyers especially, it's important, right? Their first time getting into an endeavor like this, taking on property taxes, maintenance, doing the lawn, all those additional costs. Spreading out that loan a little bit longer is a great way for them to sort of mitigate that monthly expense and also qualify for a little bit more mortgage. Okay, our resale clients, they can still take advantage of the $1.5 million cap. But if they're not a first-time home buyer, the 30-year amortization will not be available to them unless they are doing a pre-construction property. Okay.
So I guess talking about what the definition of a first-time home buyer. So based on what, CRA is saying is that anyone who hasn't owned a property in the last 4 years. And if anyone's going through like a separation or that's also can categorized under that as well. I guess like the first time home buyer and second time home buyers, they can purchase the pre-construction property with the insured mortgage option as well with the 30-year amortization. This is obviously great to help your clients. If you have any clients that are currently leasing, I would probably suggest for you to reach out to them just to have a conversation to, let us reassess their situation, right? Like Graham said, December 15th is when this, program takes in effect. So really, if the client can qualify and buy something, then it's great for them to, do that. But it's also for us to ramp up to get them ready, right? Because obviously we know even in the last, since October, it's become actually like it's become a lot busier for me and Graham anyways, because we have a lot of clients coming back to ask us to reassess their situation. So, you know, when spring market comes, it's gonna be, you know, I think strong. And I hope, everyone in this room can also set their clients up so that they can, get into the market. Because, there's gonna be a lot of, I guess, activity happening come spring.
Yeah, so this is all good news, as long as I've been in the business, or Rizwan's been in the business for a lot longer than me, but we've only seen restriction from the government. Everything was to make it more difficult, lowering the AM on insured mortgages, stress tests, everything was restrictive to make it harder to qualify. Seeing them sort of open up the doors and now ease a little bit is a step in a great direction. And we always know that they do things in steps. So another thing we're on the lookout for is stress tests. So now you can actually switch your mortgage to another lender and not be stress test, but they'll always do things in steps before they sort of launch it out across the board. So the fact that this is the first time that they looked at alleviating the stress test in certain situations for clients that are switching their mortgages is a great another step in the right direction. So all these things are helping us get more people into homes and a lot sooner. Okay, so just a little bit of numbers. We'll give you guys all the slides. I don't want to take up too much of Riz's time. But as you can see, in today's world, if somebody could qualify for like the 620, their mortgage payment would be roughly 3,400. And post December 15th, we could actually get them up to 670 with just $5,000 more in down payment. And because we're spreading out the loan a little bit longer for the 30 years, their payment's actually gonna be closer to 3,300. So they're saving, 70, 80 bucks a month, plus they're buying it for another extra 50 grand, and their down payment is only changed by $5,000. So this is the sort of opportunity that we're seeing where for the client themselves, it's a little bit more out of pocket on the acquisition, $5,000, but they're saving on their monthly payments out of the box, and they can potentially get into the property category that they will really want, right? So we're getting them a little bit of extra qualification. So just a chart, as we know, we're always in ebbs and flows. So we're used to buyer's market here in Canada, everything over asking. We know that now we're setting, whether you believe we're in a buyer's market or a seller's or a balanced market, that's wherever you weigh in on that. But regardless, we know where we're going, right? So we're headed up to a seller's market, which, sorry, I said buyer's market before that we're used to. We're used to a seller's market here in Toronto due to inventory, but we are headed up towards that seller's market. So we do have like a window that's open right now. And the window is not going to be open forever. We do know that we had large inventory on condos, things of that nature, but this inventory can be quickly absorbed. For example, I sat in a meeting 2 weeks ago with a group of individuals, and the topic of conversation was everything's sitting on the market, nothing's happening, nothing's going on. Fast forward to yesterday, talked to the same group of individuals, and there's multiple offers. Things are going, over asking. There's no inventory out there. And we know we're up 33% in November. October was huge as far as sales activity. So this window that we believe might be open for a long time, maybe not be open for as long as we think. But this is a unique situation where the interest rates are attractive. And they're in line of kind of where we're supposed to be. They're in around that range, a little over, but in a line where we should be. Like, let's just take COVID out of the equation. We know that was unprecedented times. And, those interest rates we might not see again for a long time, right? We'll see what happens to the world. But for now, we're sort of in line. So you're getting an interest rate that's attractive, but you're getting a property price that's attractive. And there is some inventory out there, especially in the condo market, to be absorbed. So if you have buyers right now and they can't qualify and it makes sense for them, now's kind of the time to pull the trigger. Because like I said, activity is up month over month and it continues to go up. And how long this window is going to be open for, we don't know. We know that we have an excess of demand. We're not building fast enough on the supply side. And we know that the supply can quickly be absorbed in a matter of weeks to months, where we're back into the situation where we're back on that ebb, and we're looking at, a seller's market where it's going to be more challenging for our clients to get into properties, right? Now they can have a condition on financing. It's a much more comfortable process, but that window is not going to be open for long. Okay, to mitigate future expenses and help people take advantage of, let's say, the future Bank of Canada interest rates, we can talk to them about a variable and maybe even adjustable mortgages where, you know, if the Bank of Canada does slash their rates, their payments will actually come down. So this is something that they could sort of take advantage of the buying opportunity today, but they can get the interest rates of tomorrow. So that's a conversation we're having with a lot of our clients. If they can qualify for it, a variable is something that they definitely want to look at. Okay. And even on the alternative side, we've got a couple of deals in with Equitable that my clients are now taking, which I've never done, to be honest. I've never wrote an adjustable rate with like an alternative lender, but now it makes a lot of sense and they're attractive. Their offers are attractive. And I'm like, I would take that in a heartbeat. It could quickly outweigh a fixed rate on the A side if you take an alternative, a variable rate on the B side. It's interesting. It's an interesting time. But let's get in front of our people. Donna mentioned our lease clients, anybody that was a first-time homebuyer that's on the fence. And we owe it to them to let them know that this window is open, but we don't know how long it's going to stay open. And they need to get in now if it's right for them. Okay. If they're looking, but they were waiting for the bottom of the market, it's argued that the bottom is here or we're very close to it. And it's only got one way to go, which is up, where we're going to see pressure on pricing. And we obviously don't have enough supply. So as this built up demand jumps back into the market, we're going to see that upward pressure, right? So if you need our help, you know, we're here. We'll help qualify them. We'll talk to your clients together. We're part of your team, and we'll ensure that they're in the right mind space and make sure that we give them the option that makes sense to them, whether it's an A lender, an alternative lender, or Riz is going to get into a little bit about reverse mortgages, which we're seeing a huge uptake in our network on. And it's really fitting a place in the market right now that we need. So he'll talk about it. I'm not going to bore you with the details because I'll sell it wrong. So anyway, without further ado, unless you guys have any quick questions, we can leave it till the end. I'm going to bring up Rizwan, who's been in the business. How many years now, Riz?
25.
25 years. So he's a veteran. I'm sure most of us have not been realtors or mortgage agents for that long, but he comes with a slew of knowledge. He's my go-to, especially for any kind of questions about trying to place a client where it's a very, very difficult file, anything stated income. Riz is sort of my go-to in order to place those alternative deals. Their rates are very attractive. They're easy to work with, and anything that fits their criteria always goes to them first. Okay. The reverse mortgages, we haven't done a lot, but we're seeing an uptake on that. We're seeing that more client need for that product, and Riz has helped us through those as well. Okay, so I'm going to introduce Rizwan. He's going to talk a little bit about the products that they have, a little bit about the reverse mortgages, and we'll be here for questions after for both me, myself, Donna, and Rizwan. Okay, all right, Riz, take it away, brother.
Thank you very much.
All right, I just don't wanna turn it off. Oh,
Clip that.
I don't know what it is.
Did you click the?
Oh, is there a button at the bottom there? Maybe. There we go. There we go. Awesome. Thank you, Donna and Graham. You know, like Donna and Graham explained, like I've been in the business for about 25 years. I was an underwriter for about 10 years. You know, and going back to different institutions, you know, A lenders, B lenders. And for the last 10 years, I've been doing sales with Equitable Bank. And, you know, it allows me to bring my expertise out on the road, especially for the broker channel that we deal with. Now, how many of you guys, I'm sure everyone's heard of Equitable Bank, right? But to give you a little bit of background on ourselves, like we're probably about the 7th largest Schedule A bank right now, just below National Bank. We have about 55 billion under assets, right? But how we classify ourselves is we talk about we're a very niche lender in a sense that we like to identify certain opportunities within the market. We don't want to do everything that the major banks are doing. We want to separate ourselves. That's why we call ourselves the challenger bank, right? And with that mindset, like, you know, it portrays in our product line. Now we're, you know, I know Chip Home Equity, you know, brought out the reverse mortgage since the 60s, and we saw a need given the demographic in Canada, especially a lot of baby boomers retiring over the last couple of years. So about 4 years ago, we started launching the reverse mortgage product. The first year was all about education because there's a ton of stigmas that go behind a reverse mortgage. And the more common one is, oh, the bank owns a home, don't do a reverse mortgage. But as the years progressed, and especially during COVID, this product has become a lot more important to a lot of clients. I'll give you an example, like, retirement homes. Remember all the issues for retirement homes? Now nobody wants to go to a retirement home. They want to stay in their house, right? Let's talk about lending. Rates are going up, qualifying is getting harder. They want to take some equity out and give to their kids, right? That's another way of looking at it as well. And I'll go through some examples. But before we get into the reverse mortgage side, my presentation that I have on the screen here is strictly on reverse mortgages. But to capitalize on our alternative lending, we have 3 niches that we concentrate on the alternative side. Number 1 is self-employed clients. We specialize ourselves on self-employed clients. Number 2 is rentals or clients that have a large portfolio of rentals. We specialize in that. And the last niche that we concentrate on, which has always been on the alternative side, is clients with, let's call it, less than stellar credit, right? With poor credit, low Beacon scores. Those are the 3 niches that we concentrate on. And I'll give you some high levels on each one of them. Number 1, self-employed, what sets us aside, we don't ask for NOAs. We don't ask for T1s. And Graham knows this. There's flexibility on how we could qualify the applicant using 12 months business bank statements. We also look at registered as well as non-registered businesses. So, you could have a client that's strictly self-employed, but they don't have a registered business, like a daycare provider or anything. And we're able to cater to that income, right? Especially on the self-employed side, there's a way of maximizing the income. So just know it doesn't matter what the client claims on their taxes, because 90% of the time we don't look at that. We look at strictly what's year to date, bank statements, what are they generating, right? So there's a lot of flexibility there. As far as loan sizes, we don't have a max, right? We did a loan about $8 million for a dentist that owns 5 clinics. There was no issues there, right? So that's the other aspect of our lending side, right? Getting into the second niche, just some high level stuff. A lot of lenders, especially your traditional A banks, they're cutting back on clients with large portfolios, right? If your client has more than 5 rentals already and they're buying a 6th one, sometimes, they're like, hey, he's overexposed. We can't offer him anything. But with us, it's max 10 per applicant. So you could have 2 applicants that have 9 rental properties each. We could still consider an additional rental property. So that's kind of like where our strength is. And the other strength is also how we perceive rental income. On the non-subjects, and this is where Graham's expertise comes in. It's a lot more favorable as we do offsets versus add backs, and we do go up to 95%. A banks traditionally do 50% add back, so they don't even use the full rental income, right? So we're able to capitalize on it. Yes, the stigma is alternative rates do tend to be a little bit higher, but look, the whole scope of the alternative space is to provide a solution to your client. Your client needs to get into the home right now. They have no option. They can't go to the A side. A B lender will step in, provide them that option. And with, Graham and yourselves, coaching the client, you're able to get them out of the alternative lender in a year's time. There's always a plan, right? And that's what the alternative space is for. It's never a permanent solution. It's always a temporary solution to get them in, find them a proper solution, give them some time, and then they have an exit strategy, right? The last niche we concentrate on is clients with poor credit. So I'm going to throw this out there. How low do you think the credit score has to be where we say we can't do it?
500.
Correct. There you go. Right. So our minimum Beacon score is 500, right? Obviously, we're going to ask why the poor credit and so forth, but we'll go as low as 500 Beacon. Now, let me ask you this. Will we consider if a client has active bankruptcy?
No.
No, correct. So if they're currently in active bankruptcy, we don't consider those deals. But if a client is in an active consumer proposal, we could still consider the deal. We don't have to wait until they pay it out, right? And just getting back to the bankruptcy, if the client discharged the bankruptcy last week, there's no vesting period with us that they have to wait 2 years, 6 months, or whatever. We can look at the deal right away, right? But once again, it has to make sense. And that's where Donna and Graham's expertise comes into play, where they'll review it and see if it makes sense, right? So those are kind of like the three niches we concentrate on. Now let's get into specific products on the B side that will benefit you guys. So Graham mentioned lending on appraisal value, right? So in pre-construction, we will lend on the market value as long as the loan does not exceed 100% of the original purchase price, right? Which is still beneficial, right? Now, you guys being realtors, you know, when you sell a pre-con to a client, right? What is the one thing that is the client is definite of, right? Like say they come down and they're like, oh, I want to buy this pre-construction, and you sold them on it. In their mind, they already know how much down payment they have, right? Whether they're getting gifted or from family or friends, that's something that they're 100% certain. You know what they're not certain of? When that pre-construction closes, whether they qualify for a mortgage or not, right? And that's where these guys come in. So that is kind of like looking at the clientele's mindset is they're like, oh, only they got a promo, 5% down, 5% in 1 year, whatever the structure is. Yeah, I could afford that, I could buy it, but they don't know whether they'll qualify for a mortgage at the time of closing, right? And some pre-cons have, you know, assignment clauses and stuff like that. So the lending on appraisal value, and I always throw this out to a lot of clients and brokers and even realtors, lending on appraisal value, don't think of it as the client getting their money back for the down payment, right? Use it to qualify the applicant. And how would you use it to qualify? Well, if Equitable Bank is going up to market value of the property, rather than taking the money and giving the money back to the client saying, hey, you got some of your down payment back, but if they don't qualify, there's no deal there. But how about utilizing that equity to pay down their debts, right? It's another way of looking at it. And this is where Graham will come up with a solution. So lending on market value, don't think of it as just an option to get their money back. It's also an option for them to qualify, right? Because that's something that's always uncertain when a client buys a pre-con, right? Another product that we have is our extended ratio program. So on our alternative side, we could theoretically go up to 60-60 ratios on a 30-year amortization. We have a net worth program. If the client can prove to us that they have 25 to 50% of the mortgage amount they're requested in liquid assets, cash in the bank, RSPs, GICs, we could go up to 80 ratios on a 30-year am, right? So there's a ton of flexibility there, right? And in addition, I know Graham asked me about what our best pricing is right now. So normally, alternative side, there's a 1% fee. We also have no fee options, right? Now, if you're dealing with clients that are strictly in the rental market, buying investment properties, like Graham said as well too, like it's a tax write-off, right? It should be a solution. Now, if they pay a 1% fee to get a rate of, you know, say 5.39, they could write that off. Now, even our underwriters have the flexibility to increase the fee, lower the rate if your client is rate sensitive, right? If the loan to value is low enough, we could even discount rates even further. So there's a ton of flexibility on the alternative side. But one good thing about Equitable Bank is compared to our competitors in our space on the alternative side, we're a bank. So we're a bank. When Graham presents that commitment to your client, it says Equitable Bank. It doesn't say credit union. It doesn't say trust or anything. We're a Schedule A bank like CIBC, TD, like anyone else, right? We just like to play a little bit different, not do what they're doing, right? Having said that, I do apologize for the long-winded intro on, on the alternative side, but I just wanted to give you a scope of it. But reverse mortgages. There's a huge demand out there. And this slide, I'm going to go through some slides here where it could benefit you guys as realtors and how you guys can identify those opportunities, right? Now we're going to go about reverse mortgages and real estate and partnering with your brokerage, right? And how we're going to go through that. So they're in demand. So as I alluded to, you know, during COVID, there was a huge issue with retirement homes. And now nobody wants to move in with their, you know, to a retirement home. A lot of people want to stay within their homes. And then the other angle of it is they want to help out their kids as well, buy their first time home or buy their investment property, right? So pensioners versus increased cost of living. If you guys have looked at the stats, you know, the cost of living is going up. Pensioners are on a fixed income. Investments not delivering a reliable stream of income. You know, during COVID, the economy has been up and down. So that's the other thing. Retirement savings not expected to last either, right? So in Canada, I'll give you an example. Like my dad, when we moved to Canada, he worked for 14 years before he had to retire. His pension is nothing, right? In Canada, you have to work, I think like 50 plus years to get a decent pension, right? So, and Canada is a country of immigrants, right? Like, so there's a lot of people that don't have a lot of pension income, right? And the other angle of it is, you know, Canadians are living longer now too, right? So, the stigmas, right? So even though the reverse mortgage has been in the industry for about 30 years, it's always had that stigma that's a last resort. Like, I'm about to lose a house, I better get a reverse mortgage, or, you know, I need the funds, right? In the beginning stages, it was very expensive, right? And it was expensive to break. And financial planners and even lawyers didn't even recommend it, right? Because once again, there was a lot of stigmas, right? But now, you know, things have shifted, things have changed, right? So now you have two major lenders in the market right now, including us, Equitable Bank, as well as Chip Home Equity, right? We are federally regulated. Rates have come down. We actually have a promo right now on a 1-year reverse mortgage, 4.99, right? That's definitely palatable, right? And now a lot of financial planners are using it as part of financial planning for investments and getting funds out of the house, right? And I was talking to Shuba yesterday, and he mentioned it's all about not letting your assets sit there. What's the word that he uses? Asset relocation. He said he trademarked it for me not to use it. So yeah. So essentially, that is the mindset right now, right? Like a lot of pensioners are sitting on all this equity. They're like, oh, I'm going to just wait until I pass away. My kids are going to inherit it. But they're not taking into account estate taxes, right? You know, the government's going to have a big hand into it as soon as, you know, the parents pass away and they inherit a house that's free and clear, right? The tax man's going to come and start taking that away. So why not start now, right? All right. So what is a reverse mortgage, right? Basically, it's a mortgage to convert their home equity into a tax-free, payment-free cash out, right? So by show of hands, how many of you are familiar with reverse mortgages?
I have some ideas.
Okay. So in layman's terms, a reverse mortgage, and I like to compare it to, picture it being a secured line of credit on your house, right? And the size of the line that you get is based on your age, okay? But there's a big difference now. On a line of credit, there's still that monthly interest-only payment that you always have to make on the funds that you've used. On a reverse mortgage, there's no interest. There's no payment required, right? That is the difference, right? So I always like to kind of compare it to a line of credit because it's more visual. So yeah, it's like a line of credit, except there's no interest-only payments required, right? That's essentially it. LTV, loan to value, is based on the youngest borrower's age. So if you have a couple on there, for us, it's based on the youngest, right?
Sorry, what
Yes.
does it mean long term? Value is based on?
It's the loan to value. So based on the value of the house compared to the loan. So,
How much is that?
so for example, if you're 55, you're looking at about 17 to 20% of the value you could take out. If you're 82, 89, you could go all the way up to 59% of the value of the house. Now, you guys are probably thinking, why, for an older person, why would you offer more for someone that's younger? Look, this is not a product that was just random numbers were thrown out. Like when they did their research, product development, even 30 years ago, it's based on life cycles. It's based on how long people live now, right? So now if you're 89 years old, you're not going to live that long versus someone that's 55, right? So now because there's no payments required on the loan, if you're older, we're able to give you more because we know there's no payments required, right? Because then there's an issue about because there's no payments required, you might get into a negative equity situation. Now, if that 89-year-old ended up living to 150, then yeah, you're definitely getting into this negative equity situation, right? But that is kind of like the logic. Like this product is designed around life cycles, right? And you'll be surprised. So in North America, Chip was the dominating one. And then now in Canada, it's us and Chip. We actually have more market share, right? In Europe, there's about 15 to 20 different companies. So Europe embraced this. North America is just getting into it. So there's a huge market here, right? And even now, it's easier to qualify. Like if your Beacon score is good, 680 Beacon plus, we don't want to see income docs, right? We could essentially take a look at it. Now, availability. We offer in Ontario, BC, Alberta, and Quebec, right? Major and medium centers as well too. Owner-occupied principal res, or it could be a secondary home where they live 6 months out of the year, right? We could also consider that. Minimum age is 55 to qualify, right? And minimum property value is 250, right? All right, how can a reverse mortgage help? Well, there's no regular payments required. Homeowners will never be forced to sell. The only thing that we ask is that they maintain the property and they're responsible for paying property taxes. That's all it is, right? We'll go up to 59% loan to value, as I mentioned. Easy approval. Customers may not qualify for other lending options. Now, how many of you guys have had pensioners try to buy properties and they've had issues at banks and banks? Like a lot of banks are like, hey, and they'll give you that typical answer. It's a concern around the continuity of income. Essentially what they're saying is they're too old. Right? That's kind of like the verbiage, right? And look, and you look at the Canadian stats right now, there's a huge amount of baby boomers that are retired, right? Where are they gonna go, right? Proceeds are tax-free and will not affect their benefits. That's another big thing. So whatever money they take out of this property, it's tax-free. Doesn't affect their pension, their CPP, EI, or anything like that. It's tax-free. All right. Protection guarantee. So here's the other thing. So now, if you're thinking, since there's no payments on a reverse mortgage, right? And say it's at an interest rate of 4.99. So the loan just grows. What happens if the loan exceeds the value of the property and the client sells? Does that mean the client owes more than what the value is, right? We guarantee that we're not going to go more than what the actual value is, right? So if the market crashes and this $1 million property is now worth 200,000 and they owe 800,000 to us, we'll take the 200, right? And we'll write off the rest. So that's our no negative equity guarantee. As long as the borrower meets the mortgage obligations and the amount they pay will never exceed the fair market value of their home, right? Now, the other thing is if there's two people on the application and are on title, husband and wife, one of them passes away, nothing happens. The mortgage just continues because the other spouse is still living in the home, right? So it's not like we come back and we say, hey, no, we have to be paid out because now there's only one of you. No, the mortgage continues, right? And even say worst case scenario, there's one person on there and they end up going to a long-term care facility, right? What happens then? Well, we give them almost a year to get their affairs in order before they pay us out. Whereas imagine if this was a TD or a CIBC and you defaulted on payments, right away they'd be knocking on the door saying, hey, we need to be paid out. Like, we respect the fact what's happening in their life. We'll give them even a year to pay us out, right? There's no rush. And we'll work with the clients as well because we know we're working with pensioners, right? So this is alluding to what happened during COVID. 96% of respondents plan to stay in their own home as long as possible. You know what it was pre-COVID? 50, 52 or 53%. So pre-COVID, it's only about 52% that want to continue to stay into their house. They actually want to go to long-term care facilities, and resort style, relax, not having to clean up. But now, post-COVID, 96% of them want to actually live in their house, right? Trillion-dollar opportunity. And this is what I mean, is that it is a huge opportunity as far as this market, right? Dealing with pensioners and especially reverse mortgages. 20% of retirees still paying for their mortgages. It's insane, right? 20% of the retirees in Canada still have a mortgage on a property, right? They're helping their kids, they're getting mortgages, but now they're to a point where they can't refinance, can't do anything. Could be an opportunity. 66% of retirees still carrying credit card debt, okay? 42% of all homeowners in Canada are 55 plus. That's huge, right? Huge market, right? Right sizing is the new downsizing, okay? 90% of Canadians want to age in place, as I mentioned, in their homes. A home is an appreciating asset, depending on which market, but you're looking at about 6.9% a year, all right? 51% have a strong resistance to move out of their community. That's the other thing, right? I'll give you an example. My parents, as much as they live in Brampton, I have a lot of issues with Brampton, but they will not move out of that area. Like, they got a 4-bedroom house, and I'm like, guys, just downsize, just come live with me. No, they're like, cool. She knows the neighbors, the ethnic stores are down the road. I'm like, okay, right? But hopefully one day soon, right? I'll be able to convince them. But here's the thing. So, it depends on the communities that we deal with too, and especially immigrant communities. They want to come to Canada, they want to own land, they want to own homes, right? Once a home is paid off, they're very hesitant to put, mortgages back on it. They're like, no, I'm comfortable, right? But like I said, it's an appreciating asset, right? Why not use those funds to help out your kids? Why not use it to invest, right? Now, our siblings don't need help from my parents, but, if I told them, hey, dad, place a reverse mortgage on, maybe buy another condo, reinvest it, you're able to do that. He's like, for what? He goes, I'm comfortable. Like, I don't need additional investments. Now, if I tell him, hey, you want to take some equity out for your grandkids, for their education, he'll line up right away. He's like, where do I sign? Right? So it's that mindset, right? It's that mindset. But opportunities to consider as a realtor. So now getting into, like, what opportunities you guys could consider. Right sizing, as I mentioned, purchasing, great divorce. How many of you guys know what great divorce is? It's like people that have been married for like 50, 60 years and put up with each other. And they're like, now that the kids are moved out, I can't stand you. I'm going to get a divorce. Like, you'd be surprised the uptick in this demographic, right? So now you have these people that have lived their whole lives together. Now the kids are moved out and they're like, I can't stand you. I'm going to get a divorce and, enjoy my great years, right? Early inheritance is another big one that will affect you guys. And this is where, the parents can help out their kids get into the market, right? And I'll get a little bit further into that. So just giving you guys some case studies, right? So for example, as I mentioned, there's no there's no payments required on a reverse mortgage, right? So let's just say you got a female, 80 years old, she's eligible for up to 52% of the value of the home, right? Property value is $1 million, right? And then the reverse mortgage she took is 300,000, okay? There's right here, the equity right now is 700, right? Because she took out 300. Year one, after a year, she's gonna have $20,000 of interest applied to that, right? But then the equity's gone up, right? Because the value of the property kind of goes up by 6.9%. Fast forward to 10 years, yeah, there's about $290,000 worth of interest, right? But the equity in the property has gone up too.
So this is based on the homeowner doesn't have any other mortgages or any other liability.
Yeah, even if they do have a mortgage, so let's just say she had a $100,000 mortgage left with CIBC, but she qualifies for 52%, 520,000. We could utilize those funds to pay out the existing mortgage as well and not have any payments, right? So that is kind of like, you know, we're never going to get into a negative equity situation because the way we've structured the loan to values on these, right? Further case studies. So let's just say, you know, downsizing, right? You got a couple, kids are moved out. You're 75 years old, house is worth $1 million. The mortgage and the existing debts that they have equate to 550,000, right? And their income monthly with the pension is only 2668, right? So using a reverse mortgage to sell their house or to purchase the new one. So the house sale price is $1 million. After the sale, cash on hand, after they pay out the mortgage and the debts, they got 430 left. The new property they want to purchase is 700, okay? The shortfall is 130, so they apply for a reverse mortgage. So we could do a reverse mortgages on purchases as well, right? So reverse mortgage 130, and then based on what they qualified, they would still have an extra 171,000, kind of like a line of credit available to them, right? So that's how you would utilize it for a purchase. Vacation properties, secondary homes, right? As long as they live there 6 months out of the year, they could tap into the equity of their existing home and purchase that investment property, purchase that secondary home, right? Vacation purchase price is 500 plus closing costs, 15,000, net is 515, property value is 1.5, based on the age of 75 and the value of the property, they qualify for a reverse mortgage of 645, sorry. Right? They use 515 for the purchase. And then a reverse mortgage cash for retirement, they still have an extra 130 left for rentals or whatever they want to do, right? Early inheritance. Now, this is where, you know, you guys will be getting more involved, right? Same thing. You know, parents have all this built up equity. The kids want to buy a house, right? And I always say this to brokers and agents where, you know, they say, you know what, the kids, you know, yeah, the parents have, you know, all this cash, equity in the property, but they're not in a position, they don't want to give them the equity right now because once they pass away, the kids are going to inherit the house and then they could use the house to buy the house, but their house. But see, a couple of problems with that is the tax man, right? They take a big chunk out of that through estate tax. Right now, the way you sell it is, what if, you know, your kids don't need help 10 years down the road. They don't need help 5 years down the road. They need help now. And you guys know as well as I do, this housing market is on fire. Like there's a huge demand, and 2025 is going to be another stellar year, right? And at the end of the day, anything that you could do to help out those clients, it's all about changing their mindset. If their parents are retired, pensioners, they don't want to tap into the equity, have that conversation with them, right? And say, listen, would you rather help your son now get into the market or 10 years from now until the tax man comes and takes half of what you earned so hard, right? So that is a huge angle, especially if you guys have first-time home buyers that you're showing around. You know, even investors that want to expand their portfolio and they're looking to purchase more properties and they want to leverage, you know, early inheritance, right? We actually have a program that I mentioned, our net worth program, right? Where we qualify applicants based on liquid assets, right? And essentially, theoretically, someone could reach out to their parents, get a reverse mortgage. The parents could gift those funds, keep it within the bank statements for 90 days. And now we could qualify the applicants based on liquid assets, cash in the bank, because it's an early inheritance, right? So there's different angles that you guys could play this, right? The other one is a more simple one. Like if you have a client that is a pensioner and they're downsizing, right? And you guys know as well as I do, if someone's lived in their house for 10, 20 years and the kids have moved out, more than likely the house isn't renovated, right? They're just like, hey, I just want to downsize. I'm good. The kids are moved out, right? But here's an opportunity where Graham could step in and say, hey, how about I give you a reverse mortgage? You use that to fix up the house. So you get top dollar on the market, right? And then in turn, Graham could help them downsize into another one, right? It's another opportunity, right? Great divorce, right? And this is what I was getting into. You know, as I mentioned, there's a lot of seniors getting divorces right now. So couples sold their home for 1.2 to pay off their 300K mortgage, leaving them with 900K. After splitting the proceeds, each of them have 450K to use towards their respective properties that they want to buy. Several buying and selling opportunities for you guys there, right? Wife, she'll purchase a 800K condo using 400K from the proceeds, right, to her home towards a down payment, uses a reverse mortgage to bridge the difference, right? Husband buying a semi for 900K, same thing, uses a reverse to bridge the difference, right? It's all about identifying the demographic and these opportunities when you guys are out there, right? Any questions? When they pass away or when they move to a retirement home, right? No, the interest accrues based on the balance they've used. It just keeps on accruing. Now, your clients do have options. Say they're like, hey, I don't want whatever I've used for that interest just to accrue and the loan grow. I want the option to make monthly payments, just like a line of credit. Yes, they could do that, right? So the loan never grows. And every anniversary year, they're able to pay down the principal balance by 10%, right? The key here is leveraging an asset to take out the equity, and they could invest it. They could help out their kids. They could pay off their bills. They could renovate the property. There's a lot of options, and it's all tax-free, right? Doesn't affect their CPP, EI, nothing, right? Any other questions?
Temporary divorce, it's called reverse mortgage as well.
Yeah.
They sold.
Yeah. So I was just giving a scenario, right? They had a matrimonial home, they got a divorce, they sold, split the differences, you know, and like I said, it's just with you guys being out there, talking to clients, seeing what type of clients you have. You know, if someone that's a pensioner getting a divorce, this is an opportunity for you guys to get two deals out of one, right? Yeah.
So I guess the point here was they can get the reverse mortgage and buy new.
Oh, here.
for
Yeah,
themselves,
yeah.
not the
Not that.
original.
Yeah, not for the original, right? Yes.
Thank you for your valuable information. I see a lot of our agents struggling to take some good pictures.
Yeah,
Would it be possible to get?
I will. Well, she already has it. Yeah. Yeah.
Thank you guys, nice pictures. Okay?
Thank you.
Thanks, Riz. Appreciate
No
that.
worries. Thank
Just
you.
Before we wrap up, and if you guys have more questions, the key that I look when Riz is presenting the reverse mortgage and the reason we wanted him to come today is we want to represent some opportunities we've seen in our business and things that we've done. So a couple of key things that he was mentioning in that presentation. So one is to open up the gift of mom and dad. Okay, so we have opportunities. We have people that their parents would like to help their kids. The only asset they have, they don't have investments, they don't have 200 grand sitting in the bank, but they have a property. And they want to see their kids that might be living with their grandkids get into property ownership earlier, and they want to see their kids flourish in that. So what we've done in many cases is, in order to increase the down payment for their kids, those first-time home buyers, we would put a reverse mortgage on the parents' house because they're going to get the money anyway. They still live in the same house. For them, their day-to-day has not changed. They're not making any monthly payments. Nothing's changed for them. But they've and this is Shuba's, Shuba's word, but they've reallocated to another asset. So they've taken, 200,000 and put it into their kids' asset. So they're not giving 200,000 for their kids to go to the casino. They're saying, look, I'm going to help you get another appreciating asset, and I want to see this before I go. Right. And when we present it that way, they really appreciate the fact that, they can help their kids and be able to see it, and see their grandkids also be able to enjoy that experience of getting into their first home. Right. So we see a huge opportunity there. Another thing we've seen a lot, and this is a double-end deal that we do with realtors, is the downsizing. Right. So a lot of people do want to stay in their home, but some people, 5-bedroom house, 4-bedroom house, kids are gone. I can't go up the stairs anymore. Whatever it is, I need a condo. I want to get out of this property and downsize. But, you present it to them, okay, you're going to walk away with all this money. You buy something cheaper, then you're left with 50 grand. But I got to live, right? I got to pay property taxes, maybe condo fees. I want to go on vacations. I want to enjoy my life. But in this opportunity, we can get them a reverse mortgage so they can keep more of those profits from the proceeds of their sale, and they can keep more of the money in their pocket so they can invest, maybe give to their kids, whatever it is, but they'll have more money in their pocket, and they don't have a monthly payment, and they can enjoy their retirement. And this is all about helping people enjoy their retirement. And part of that is seeing their kids flourish, right? Like if I'm retired and I have kids and grandkids, if I can help them while I'm alive, I'd rather do that than wait until I pass, just knowing, okay, they'll be fine when I'm gone. And I don't want them hoping that I go sooner than later and pulling the plug on me. So I'd rather help them sooner. Okay. And one more thing that we have helped, and I'm just giving real life scenarios on what we've done, is people that want to stay in their home, have a lot of equity, but now they want to travel. And some of them have that destination. I go to Dominican Republic every year. I hate the winter in Toronto. I want to go there. We all know property prices abroad are a lot cheaper here, and we will take a reverse mortgage so they can buy that property, and that's more comfortable for them. Instead of staying in a resort every time, they can just buy a property abroad, cash, because they took the cash out of their property, and now every winter they can winter somewhere else, and it's not costing them anymore. Right. And they can enjoy their retirement. So I see most of this as ways to help people enjoy their retirement. And part of enjoying retirement is seeing the next generation flourish. Right. So that's what we sort of focus on when we're doing reverse mortgages, are opportunities of that nature. And they all come with a sale transaction usually, and potentially a purchase. Right. So that's kind of what we're seeing. Yeah, Liz. Yeah.
Because there's a statement about reverse
Mhm.
mortgages when
Yeah.
the parents died.
Correct.
Everything is gone, right? But
Correct.
that is only, how many percent was the lending?
No, so the way it works is based on the client's age is the loan to value.
Yeah.
Right, that the client qualifies for. So let's just say property value is $1 million and they're eligible to take out 50%, they take 500. Now, as I mentioned, it's kind of like a line of credit, right? So they're approved for 500, but they're like, I don't need 500, I only need 300. But it's nice to have the extra 200 just in case. And they only use 300, 10 years go by, they still use 300, the interest just accrues on it. They choose not to make any interest only payments or lump sums. And if they pass away, whatever the loan is, the balance, not the limit, that is all we require to be paid out, right? And another thing to remember is the clients continue to remain on title of the property. So it's not like the bank is on title or anything. No, it's just like any other mortgage, right? If they do pass away, we waive any sort of penalty, right? Because we understand, it's inevitable that happens, right? If they move to a retirement home, because one of the caveats is the property has to be owner occupied, right?
was not for rental properties. It has to be their principal res, or at least live there 6 months out of the year. Now, if they move to a retirement community or move to a, a hospice center or whatever it is, even then we'll give them a year to get the repairs in order. We're not on their door the next day saying we have to be paid out, right? Like, we understand the sensitivity of dealing with pensioners, especially in Canada, especially the regulators. If you screw over a pensioner, it's like they'll come down on you hard, right? So we're very sensitive to that. And having said that, it's just like your typical mortgage. And like you said, there's a lot of misconceptions out there, right? The bank's gonna take your house and never get a reverse mortgage. You're never gonna be able to pay it off. It's just like a line of credit. If you choose to make monthly payments, you can. If not, that's okay as well. And every end of the year, you can pay down, right?
Can I ask you just what had happened using an example, like, for example, the loan value was 500,000.
Right.
And then they decided to take the whole thing.
Yeah.
And then accumulate interest, by the time
Right.
they pass away, would it be possible, like, would this be possible that the whole amount become 1 mil? And
Yes,
the-
100%.
the
It
whole value of
goes-
the whole stock?
Not necessarily,
Okay.
because you also have to look at a house as an appreciating asset.
Yeah, that's the variable you have to,
Yeah.
So depending on the market there, right, it could be anywhere from 3.5 to 6.9% appreciation per year, right? Now you throw in Canada, the demand that's out here for housing, right? And, we have these conversations offline. I think next year is gonna be a lot of bidding wars, like the value is gonna start going up,
Mhm.
right? But that, hypothetically speaking, let's just say the loan amount does get to 1 million and the value is only, say, 900,000 now. Say the value came down a little bit. Even then, the loan continues, but when the client decides to sell, right, we will only take whatever the market value is at that time. We're not gonna come after the clients personally for the remainder of the difference, because it's a market. We assume that risk, right? But that's how confident we are that we know that it's never gonna get to that point, right? Unless you live to be 150 years old, right? Then that's a different story, right?
But that's the back of the wall, right?
yeah.
Yeah.
Yeah, and I think that's the key in that scenario, because people think, oh, it's $1 million, I take 500, all my interest is gonna eat all the $1 million, and it's like, yeah, 15 years have gone by, what's your property worth? And often, like Riz said, it's not gonna happen in 1 or 2 years, but he had a scenario where in 10 years, there's a great chance that the amount of interest that you paid is gonna be less than the amount that your property is appreciated.
Yeah.
Right? So in essence, that money didn't cost you anything because it's still secured to an appreciating asset, right? People forget about the fact that, yeah, but you're talking about in 20 years, my property's not $1 million anymore, it's 2. Right?
Because a lot of clients have that mindset, like you mentioned,
Yeah.
is that, oh my God, I'm not making any payments, so the
Mhm.
loan's just gonna eat up the equity. But this is where you explain to them, yeah, the value of your home's going up too, the equity is actually increasing.
Exactly.
Right? But getting to investment, you wanna take the money out now. Get into, estate taxes, because a lot of pensioners think that as soon as they pass away, that free and clear property goes 100% to their kids, and they don't have to worry about making, the probate tax based on the equity, right? Like, why not take some equity out right now? There's less probate tax if they pass away, right? And they could help their kids out now versus 5-10 years from now,
My
right?
second question to do with the probate, because right now it's around probably 9 months of waiting for it to come out, for
Yeah.
for them to sell. Well, say for the parent pass away, so during those 9 months, I guess the loan's interest just accumulates.
Yeah, until
Until
we
it's
get
done.
paid up. Yeah. So the loan just still continues on the used balance, not the limit, right? Just whatever they've used, the loan just accrues, right? But if you have clients that are sensitive to the loan just accruing, have a chat with them. Like, they could pay interest only payments and the loan never grows, right? Just like a line of credit. And, a lot of people, what they've done is they've consolidated their existing mortgages because they don't want payments. Now they're a pensioner, they're a little bit tight, right? And they're like, hey, I can't afford my mortgage because I helped out my kid already. And, I'm on a pension income. You know what? We've offered reverse mortgages to consolidate everything. They don't have to make any payments throughout the year, but you know what they're doing with that money? They're saving that money. At the end of the year, bam, they're just paying it down, whatever they could afford, right? There's different ways to slice it, how you want to take a look at it, but there's just once again, $1 trillion opportunity, right? Sure.
What's the interest rate on reverse mortgage compared to regular mortgage?
Look at it this way. Our 1 year, our right now, our 1 year alternative side is 5.59. 3 year reverse mortgage is 4.99. It's lower.
Yeah, it's insane.
And you know what the fee is on I mentioned a fee on the alternative side is 1%. You know what the fee is on the reverse mortgage? $995. One-time fee. That's it. Yeah. It's lucrative. It's very lucrative, but you need to be able to identify the opportunities. And like I said, anytime you're out there with clients shopping, they're looking at homes, you know, if they're young and they're like, oh, I can't afford it. Well, you know, what's your parents' situation? Are they willing to help you out? Oh no, my parents are pensioners. They can't. Well, there may be opportunity you could get into this house, because everyone knows when clients are looking for a house, it's an emotional sale. It's never a mathematical sale. As soon as they walk in the house, they're like, oh, I love this. How can I afford this? How can I get into this house? I picture myself here, right? So why not capitalize on the opportunity to ask them the question about, okay, well, how much down payment? Okay, well, it may be a little bit higher, but what about your parents? Can they help them out? No, they're pensioners. Well, there's a product that could help them out, right? Yeah.
So.
Yes. People on title, do they all have to be a specific age in order to use it?
Yes. So the way it works is on a reverse mortgage, right? On a reverse mortgage, it's everyone on title has to be 55 plus. So they can't add their kids on as guarantors or anything like that. It's just title only. Yeah.
So actually, let's talk about that.
Sure.
What if it's the client has their child on title? So how would that work?
So the way it works is so the question was, let's just say the parents have their kids on title right now and they want to apply for a reverse mortgage, right? We could facilitate a refinance, reverse title transfer. Yeah. So we could actually, throughout the process, give them a reverse mortgage. At the time of closing, take their kid's name off the title. So we can actually facilitate that. What we cannot do is if the child is the only one on title and the parents are currently not on it, we can't add them on and take the child off, right? So what I would suggest, if you do have a situation like that, get the title transfer done first, then submit it. But if it's a situation where the parents are on it with the kids, we could facilitate that. Yes.
Finance, give them a first mortgage?
Yeah, a reverse mortgage is always in first position. Yeah. Yeah. And a common question that does come up is, hey, do you guys allow second mortgages behind a reverse mortgage? Right? If they want to tap into some additional equity because they're maxed out based on their age, will you guys allow a second mortgage? And the quick answer is no. And to your point, it's about the negative equity. Now imagine if they're not making payments on that first mortgage and all of a sudden they take out a private of 300,000. Now you're going to get very quick to that negative equity situation, right? So that's a reason why we don't allow a private second behind a reverse. Yes.
That, and I said, well, they don't, but, sorry, I just lost my train of thought. It's very hard to find a lender, a private lender who's gonna go behind a reverse because it is eating up to that equity and they know at payout, the reverse gets paid out first. So if there's not enough equity, they're gonna lose money.
Yeah.
Right? So it's very, very difficult to find privates who will do that, and if they do, they're charging a lot. to
Yeah.
do it.
Is there like a minimum term for the reverse?
We offer 1 to 5 year terms, right? Now, here's the thing. It's a non-amortized mortgage. So it's not your traditional mortgage. There's no amortization on a reverse mortgage, right? And even renewal, say they take a 1 year, right? we don't even call it a renewal. We call it a rate reset. It's kind of like a renewal, but it's just a fancy way of a non-amortized mortgage. So at the time when the 1 year is up, just like any other renewal, we send them documentation. Hey, based on the current markets, this is what the current rates are. What do you want to go for? Another 1, 2, 5 year term. To be honest, it doesn't matter what term they go with, but what you have to be cognizant of is, say if a client wants to pay it out in 2 years, right? It doesn't really matter, because what you're trying to do is just capitalize on the rate. So my suggestion is just go whichever option has the best rate. Penalty is going to remain the same. It doesn't matter when they pay it out, right? And worst case, unlike our competitor, right? Our penalty, right, is 5 months interest. Okay, it's 5 months interest, and which is the lowest in the market right now. So worst case, so if they pay us out in the first year, it's 5 months interest. If they pay us out in the second year, it's 4 months. Year 3 to year 10, it's only 3 months interest. If they pass away, we waive the penalty. If they, yeah, if they move to a long-term care facility, we'll waive the penalty, right? So we work with the clients as well, right? Yeah.
Yeah, a alternative way to get away with it.
From a probate. Look, I mean, what I'll do is I'll be very careful how you want to position that, especially because if you're getting into probate tax law and guiding clients, they're going to say, well, my realtor said this is the best way, right? Yeah. No, look, for yourself. Yeah, definitely. If you have a house right now and you're at a reverse mortgage age, rather than leaving the equity in there, take the equity out with the reverse mortgage, because God forbid if something happens, the probate tax is based on the equity in the property, right? So if there's no equity, there's less tax, right? So that's, yeah, it's a good way of looking at it, right? Any other questions?
We're good. All right,
No,
well, thanks, guys.
awesome.
Appreciate you guys coming, and we'll hang around and you guys have a good discussion. Thanks, Riz. Appreciate you always.
Thank you.
What